Hi everyone, welcome back to Chapter 7. It is part 2 of our discussion where we're going to focus on notes receivables first and then talk more about accounts receivables and some special things we do with cash. So notes receivables is when the company has a formal arrangement with a debtor that they loan money to. So it's in writing, it's a loan. They could be less than a year or more than a year. And the time period will determine if it's considered a short-term note or a long-term note. Short-term interest-bearing notes are the first ones we will tackle. So these are notes that are traditionally less than 1 year in length. So the loan will only be made for a few months. Now, for our purposes, the assumption is we loan the money out one day, and then at a future date, a maturity date, the amount we loaned plus interest for the time period the loan was outstanding will be paid back to us. So we calculate interest on the face amount of the note times the annual interest rate. Remember, that's annual, and that's always what's on a loan or a note. Even if it says it's only a 90-day note, the interest rate is still for a full 12 months. So we may need to allocate the interest to the period of time we need to calculate it for. So it depends. If it's in terms of days, it might be 90 over 365, or if it's in terms of months, the number of months over 12 to determine the interest just for that period of time. So in this example, Stridewell Wholesale Shoe Company manufactures athletic shoes that it sells to retailers. On May 1st, 2021, the company sold shoes to Harmon Sporting Goods. Stridewell agreed to accept a $700,000 6-month, 12%, remember that's an annual interest rate, note in payment for the shoes. Interest is going to be received at maturity. Okay? And this interest rate is normal for loans of this type. So on May 1st, when the sale occurs, the company, Stridewell, will debit notes receivable and credit sales revenue for the $700,000. Keeping in mind, notes receivable is an asset. On November 1st, 6 months later, they will receive their $700,000 back and 6 months worth of interest. You could see the calculation at the bottom. The face amount, $700,000, times the annual interest rate of 12%. Since we only need to determine interest for 6 of 12 months, our fraction is 6/12. So the interest revenue that Stridewell will recognize, $42,000. So Harmon will be paying back to Stridewell $742,000 in cash. So that is how we record notes receivables. You may remember it a little bit from Accounting 111. What happens if this occurs? Just to backtrack, in our first example, the note began and ended in the same accounting year. But what if this note instead was dated August 1st and it's 6 months? So September 1st, October 1st, November 1st, December 1st, January 1st, February 1st. So this loan is not going to be paid back to Stridewell until February 1st, 2022. Well, remember, interest is always occurring. So interest is constantly being earned on this note. So at the end of December, Stridewell must recognize the portion of interest that has been earned by the end of the year, or 5 months. All of August, all of September, all of October, all of November, and all of December. So 5/12 times 12% times the 700,000, or 35,000, will be credited to interest revenue and will debit interest receivable, and it will sit there until Stridewell receives that money. Now, February 1st, when they receive the full $742,000, because this is a 6-month note and they will receive 6 months of interest on February 1st, along with the $700,000. Well, the company Stridewell will credit note receivable for the face, the $700,000. They'll credit interest receivable for the portion of the interest that's already been recognized as revenue last year and is sitting in a receivable. Now it's being paid to us. And the remaining 1 month of interest that occurred in 2022 can now be recorded as interest revenue. So when you have a note begin in one accounting year and end in another, you're going to have an adjusting journal entry for the accrued revenue on that note, as we just saw. Sometimes, though, notes are what we call non-interest bearing. That doesn't mean they don't have any interest. It's just that on the note, it doesn't have a stated rate of interest. Instead, what happens is that a person or a company will loan the money, and instead of loaning the face amount, they'll lend a lower amount. The difference between the face amount and the amount loaned is the interest. Okay? That's the interest because the borrower took less upfront and will pay the full amount at the end. Well, we can't just call all the interest revenue the day the loan begins because no interest has occurred on this, and we're not allowed to call interest revenue until we've earned it. So the day the loan is given, the difference between the cash given to the borrower and the face that is due at the end is stored in a contra asset account, discounts on notes receivable. So let's take a look. Stridewell sold shoes to Harmon, accepting a 6-month $700 non-interest-bearing note in exchange for delivering goods that have a cash price of $658,000. So sales revenue is only $658,000. That's how much they took. Harmon took on the day the loan was made, $658,000. What are they going to have to pay back? $700,000. So we debit note receivable $700,000. The difference is credited to discount on notes receivable. Now, 6 months later, we're still in the same accounting period. That's when Harmon is going to pay back the $700,000. The entire time period has lapsed for the loan. So all the interest being stored in the discount on note receivable account has been earned by the end of by the time the note is being repaid to us. So first we're going to remove the balance in the discount on note receivable by debiting it and showing it all in interest revenue. And then Harmon will be paying back $700,000 in cash, so debit cash and credit note receivable. So this is how we handle a note that doesn't have a stated interest rate on it. The borrower takes less money up front and pays back more at the end. That difference is really the interest on it. So another calculation, we've seen this already, is what is the effective interest rate Harmon is really paying? Well, they paid $42,000 in interest, right? On what? $658,000 sale price. So how much that's a 6-month interest rate of 6.383. So the interest rate really wasn't 12% they paid, but 12.766. They took less upfront, but still had to pay the $42,000. And by the way, that difference is interest for 6 months. It's on the $700,000 though. Here's another example. Stridewell shoes. I'm accepting a $700,000 non-interest bearing note. Okay, so it's the same example. Same journal entries we just saw when the note began and ended in the same accounting period. What happens if this note begins on August 1st? That should be August 1st. And ends on February 1st. So this is now a 6-month a 6-month note that began on August 1st. Remember, interest is always occurring. The portion of the interest that has occurred, or you could look at it as 5/6, that $42,000 that's sitting in the discount on note receivables represents 6 months worth of interest. 5/6 of it, or you can calculate it as you see there, now must be recorded as interest revenue at the end of the year. So you don't wait to debit that discount on note receivable contra account, or transfer. You need to transfer part of the interest in that account into interest revenue by the end of the first year because it's been earned. The remaining balance will be transferred to interest revenue, as you can see on the February 1st first journal entry, and then we'll debit cash and credit note receivable for the receipt of the $700,000. Remember, one more time, discount on note receivable is a contra asset account, so it begins with a credit balance. To reduce it, you must debit it. What is in that account? Interest. Interest we're not allowed to recognize until it's been earned. As we earn it, we take it out of the discount account and put it into interest revenue. Okay, so those were short term. Now we'll take a look at long term. So in this case, Harmon Sporting Goods bought off Stridewell. Stridewell allowed them to sign a note for 2 years now. 12% interest rate, $700,000 was the amount they borrowed. Okay. Now, in this case, it looks like there's no stated interest rate. So, and that's what made me a little confused there. Sorry for that. But it's basically saying they're going to pay back a $700,000 note at the end of 2 years. Assume there's a 12% effective interest rate. I thought they were buying stuff worth $700,000 and going to pay back $700,000 plus 12%. But that's not the case here. This is like a non-interest bearing long-term note. Well, here comes the tools of present value. What do we have here? How much sales revenue do we have? Well, what does this transaction say? Okay, we sold stuff today. We're going to receive $700,000 at the end of 2 years. Well, that's what we're going to receive at the end of 2 years. What is the value of that $700,000 today? So we're looking at the present value of 1, and it's 2 periods. Interest is 12%. So we find our factor on our table 2. 700,000, the future value times 0.79719. The sales revenue, what is the value of that today, is $558,036. So that's what we loaned out, essentially, a value of $558,036. What are we getting at the end of 2 years? $700,000. So the difference is credited to our discount on note receivables. That happened January 1. This spans over a 2-year period. So over the next 2 years, we're going to have to recognize interest revenue related to this loan. And here's how we do it. At the end of year 1, we must calculate the carrying value of the note. So you got to take the little notes down right now. The carrying value of a note is the note receivable balance minus the discount on notes receivable balance. One more time. The carrying value is the note receivable balance, $700,000 in this case, minus the current balance in discount on notes receivable, $141,964. Multiply that by your annual interest rate of 12%, so the $558,036 times 12%. So we're calculating interest on the balance of the notes receivable right now. Since we need interest for a full year, it's like we're multiplying that answer by 1. So we'll debit the discount on note receivable, $66,964, and credit interest revenue. So that's how much of the interest revenue is recognized. Now this note will be paid off at the end of year 2. We must calculate the interest at the end of year 2. Now remember, when you debited the discount on note receivable, you essentially increased the value of the note. And do a T account. Create a T account with a credit of $141,964 for the discount on note receivable. Then on the debit side, enter $66,964. That is the new balance of your discount on notes receivable. So I didn't do that as I was saying it, so I'm grabbing my calculator. I don't have my glasses on. Let's see. 141,964 minus the portion we've already recognized, 66,964. Recognize that portion as interest revenue. So 75,000 is the balance in our discount on notes receivable. Well, 700,000, the face value of the note receivable, minus 75,000, the carrying value of the note receivable is 625,000 as of the beginning of 2022. Multiply that by 12%. The interest revenue for the year is 75,000, and it will be because that's the remaining balance in the discount on note receivable. That remaining balance is the amount of interest you must recognize in the second year. So debit discount on note receivable, credit interest revenue. But we wanted to show you, you can calculate it too to make sure you're right. Then debit cash and credit note receivable. So all different ways notes receivables can present themselves. Interest bearing, non-interest bearing. So Finkel sold merchandise to a customer in exchange for a 4-year non-interest bearing note for $10,000. An equivalent loan would have a 10% interest rate. Finkel would record sales revenue on the date of the sale equal to. Now remember, that $10,000 will be paid back at the end of 4 years. We're trying to figure out what's the present value of that, and it would be C. The present value of $10,000, 10% interest rate for 4 periods. So that calculation would give us how much we credit sales revenue for. Now, in this case, what happens if we just loan money for cash? So here is Stridewell accepts a $700,000 2-year note in exchange for loaning $700,000 to Harmon. Debit notes receivable, credit cash, $700,000. Okay, and then we would follow through with all the interest computations. The other side is, what happens if somebody doesn't pay us back? Well, just like accounts receivables, if a company anticipates bad debts on short-term notes receivable, it uses an allowance account to reduce the receivable to what they think they're going to collect. Okay, so if this company has a few loans out there and they feel maybe they're not going to receive all the money back, they need to honestly estimate that, just like they do accounts receivables. There is a CECL model for this as well. So we're going to consider all relevant information when assessing credit losses, including reasonable and supportable forecasts about the future. Companies can use a variety of approaches to estimate uncollectible notes receivables, including an aging, like we did for accounts receivables. Often, companies use discounted cash flow techniques. Now we're getting into a lot of like finance calculations. But it's just like saying, here's what we expect to get over the next few years. 10,000 next year, 20,000 of it the following year, 15,000 at the end of year 3. We'll determine what the values are today of those 3 payments you expect. And the difference between that and the note is the loss, if it's less than your note. So there's all different ways of determining this loss. When it comes to international accounting, U.S. GAAP allows for a fair value option for accounting for receivables. So does IFRS. So that means you always report them at their fair market value, whether it's above what the original amount is or below. Okay. When it comes to accounting for receivables as available for sale investments, no. That's only a category for investments. Okay, but IFRS doesn't allow that either. The estimation of bad debts under IFRS is a 12-month estimated credit loss, ECL. The estimation of bad debts, we're going into 2020 with the CECL model where we're looking at all items when we're estimating for losses on our receivables. Okay, so that was notes receivables and how we even have to estimate and create an allowance for bad debts or uncollectible notes receivables account. We just don't do it for accounts receivable. Now we're going to look at financing with receivables. So receivables are an asset. We can use them as collateral on a loan. This is called secured borrowing. So we pledge our accounts receivable as collateral. So we say to the bank, give us $100,000, we'll pledge as collateral $130,000 of accounts receivables. So if we default on the loan, those receivables are the bank's. The entire receivable balance serves as collateral, sometimes only partially. Responsibility for collection of the receivables, though, is still with the company. So they're just using them to support a loan. They're not transferring them out of the company. They still own them. This type of arrangement should be described in a disclosure note. The other type of financing is actually selling the receivables. So now you're no longer owning the receivables and they're an asset to somebody else. They can be sold at a gain or a loss. And the accounting treatment for them is similar to the sale of any other type of asset. Why do companies do this? They need the money. Right now it's a receivable. If they need that money quicker than they could wait those 30 days, they have these options. Now, sometimes companies pledge accounts receivables collateral, as we said. There's maybe no particular receivables are associated with the loan. Rather, the entire balance serves as collateral or a portion of the balance. The responsibility for collecting them still remains on the company, and there's no special accounting treatment while you're collecting them, but you should disclose the arrangement in a note to the financial statement. And here's an example of revolving credit facility is an asset-based line of credit that is subject to a borrowing base limitation and generally provides for advances of up to 85% of eligible accounts receivable. Okay, so that's a loan. Verco Manufacturing has a line of credit and they use 85% of their receivables to collateralize against it in case they default. Alternatively, companies can assign particular receivables to serve as collateral for loans, like a mortgage on a home. The lender typically lends an amount that is less than the amount of the receivables assigned by the borrower. The difference provides protection for the lender in case, just like when you borrow money for a home or a car, they normally don't, well, sometimes with a car they do, but with a home, they don't normally loan you the full amount of the house, they require you to put some money down on it. Or if you don't, you have to take an insurance policy to protect some of the amount of the mortgage. Meaning, if you default, the bank will get that part, even though your house may not have sold for the full amount of the mortgage. So traditionally, companies, when they're in this situation, they'll go to the bank. I have $100,000 of accounts receivables. I can use as collateral. The bank will go, okay, we'll loan you $70,000, but we'll use $100,000 of your accounts receivable as collateral, just in case any of them don't pay. They're still covering themselves. The lender usually charges the borrower an upfront financing charge and interest on the loan, so it's not for free. The receivables might be collected either by the lender or the borrower, depending on the details of the arrangement. Here's an example. Santa Teresa Glass on December 1st borrowed $500,000 from Finance Bank and signed a promissory note. Interest at 12% is going to be paid monthly. the company assigned $620,000 of its receivables as collateral for the loan, and that's normal. We just talked about that. Finance bank charges a finance fee equal to 1.5% of the accounts receivables assigned. So they borrowed $500,000, but they're not going to receive $500,000 because they have to pay a finance fee immediately for this loan. What is the finance fee based on? The collateral value, $620,000 times 1.5%, or $9,300. So that is charged immediately to a finance charge expense. It's not interest. It's just the charge for making the loan. It's a bank fee. The difference is how much money they're going to receive. So it's almost like saying they got $500,000 and they immediately paid it a finance charge. Now, what happens as time passes? Let me see. Santa Teresa will continue to collect the receivables and record any discounts, so sales discounts customers take, sales returns, and bad debt write-offs as their own. But will remit the cash to Finance Bank, usually on a monthly basis. So as they collect accounts receivables, they're going to send the money in because remember, they're collateral. So they collected 400 of the receivables assigned are collected in December. So Santa Teresa will debit their own cash account and credit accounts receivable because they are still assets on their books. They're just being used as collateral. Remember what they owe. They will owe the amount that they collected. So they're going to debit their liability financing arrangement liability account because they're paying that part off. But they also have to pay interest monthly. And the interest is on the amount they borrowed. $500,000 times 12% times 1/12. That should be times 1/12, not equals. 1 month of 12 months. The current loan balance is $500,000, and that's why we use that. So $5,000. So the amount of cash being remitted to the finance bank, $405,000. And there it is in receivable. Now take a look here. Collected 620, or 620 was the balance, collected 400, 220 left. Started with a $500,000 amount owed, paid off 400,000, still only owe 100. You got to keep that in mind going into the next month. And of course, they did a quick check here. So let's take a look. Jada Company borrows $100,000 January 1 from Northeast Bank at a 12% interest rate. They assigned or used as collateral $140,000 of its accounts receivables, and they agreed to pay a financing fee equal to 2% of accounts receivables they assigned. In the accounting transaction, well, think about this and do the journal entry. Credit liability financing, or you'd even put notes payable, $100,000. Debit financing expense for $140 times 2%, because that financing fee is on the amount of collateral, or $2,800. So how much are they really going to receive of cash? $100,000 minus $2,800, $97,200. So there's our journal entry. Okay, so now what if instead it was an outright sale of the receivables? This means the company who is selling the receivables, that would be us in this case, the accounts receivables, we are physically taking the asset out of our name. It's no longer ours. So we need to remove any receivables we're selling. We need to recognize any fair value of any assets acquired or liabilities assumed by us in the transaction and record the difference as a gain or loss, just like we do when we sell anything else. Remember, when you're selling, here's us, the company, you sell accounts receivables to the bank or the financial institution. They now own them. So they become responsible for all collections related to the accounts receivables. So the financial institution becomes the new owner. They buy accounts receivable, and it's not free. They charge a fee for doing this. Okay, this is getting beyond us. Here we go. Sales with or without recourse. This is what I wanted to go into. When a company sells their accounts receivable, they could either sell them without recourse. What does this mean to them? The buyer cannot come back at the seller for uncollectible receivables. So when this buyer takes on the accounts receivables, they take on all responsibility of collecting the money. If they're sold with recourse, the buyer has the right to come after the seller for uncollectible accounts. So to compensate the seller for retaining the risk of bad debts, the buyer usually charges a lower factoring fee when receivables are sold with recourse. So we're going to see how we create journal entries in each of these scenarios. Accounts receivables are factored, and factored is just a fancy way of saying sold without recourse. And sometimes a bank will do this, or there's actual factoring companies, so companies who specialize in buying accounts receivables. In December 2021, Santa Teresa Glass Company entered into the following factoring arrangement, so sales arrangement. Santa Teresa transferred accounts receivables that had a book value of $600,000. The sale was made without recourse. The factor immediately gave Santa Teresa 90% of the amount as cash. The factor retains the remaining 10% to cover its factoring fee, which is 4% of the total factored amount, so that's its right upfront charge, and a cushion against potential sales returns and allowances. After the factor has collected the cash equal to the amount advanced to Santa Teresa plus the factoring fee, factor will remit excess to Santa Teresa. Therefore, Santa Teresa does have a beneficial interest in the transferred receivables equal to the fair value of the last 10% of the receivables to be collected, less the 4% factoring fee. Let's see how that all drives out. So, they sold $600,000, so Santa Teresa's crediting accounts receivable $600,000. They're gone. They're only receiving $540,000 in cash, 90%. There is a $24,000, 4% on $600,000 instant fee. Okay, $26,000. Okay. There is, and this was in the information there, a $50,000 amount that could be returned to Santa Teresa. Why? Well, Santa Teresa is the company who sold the goods to the customer. When a customer returns goods, they're not going to go to the factor and return goods and say, hey, do you want to decrease the accounts receivable and I don't have to pay you that? Ha ha ha. No, what they'll do is they'll come to Santa Teresa and say, here's the stuff I bought from you, decrease the amount I owe you. Well, Santa Teresa can't say, sorry, can't do that, it's already sold your accounts receivable balance, too bad for you. No. Instead, they'll reduce this receivable from factor account. So if nobody returns anything during that relates to these $600,000 in accounts receivables, once the factor collects all $600,000, they're going to return $26,000 to Santa Teresa. So they still have a vested interest in some of that money. It's just that they have to wait till all the money is collected. Now, that doesn't mean if a bad debt occurs that the factor could come after them. No, this is just for sales returns and allowances that may occur from the day they sold the receivables to the actual collection date related to the $600,000 in receivables. Okay, so that's what that represents. And then the difference between the debits and the credits here is the loss on the sale of receivables. So we plug that in. Assume the same facts, but now they're sold with recourse. When the receivables are sold with recourse, Santa Teresa still may be liable for accounts that could go bad. So on the day of the sale, they are creating a liability that they may owe to the factoring company for any accounts receivables that never get paid to the factor. And they estimate that, and it's called a recourse liability. So they determined, based on the $600,000 they sold, they estimate maybe 5,000 of them will not be paid. So that's a potential liability the day they sell those. Credit recourse liability. It's just a liability account. Credit accounts receivable. They're still only receiving $540,000 of cash. They still have a receivable from factor of $26,000. The $50,000 minus that fee they have to pay. And then the difference between all those accounts is the loss on the sale of receivables. So the major difference between the two journal entries with and without recourse is with recourse, your loss is going to be higher because of that potential liability you needed to add in. Which of the following is not true about factoring receivables? B, a transfer without recourse means that the transferor bears the risk of the receivable not being collected. And the transferor is the person selling, or the company selling. The transferee is the one buying it. So that's not true. Transfers of notes receivables. Companies can obtain immediate cash from a financial institution by pledging a note as collateral for a loan or by selling the note. So just like you can sell accounts receivables, you might have a note receivable that you can sell so you can get your money quickly. And it works pretty much the same way. The company will sell their note receivable to a financial institution. The financial institution will give the company money and charge them a financing fee. For instance, on December 31st, Stridewell Wholesale Shoe Company sold land in exchange for a 9-month 10% note. The note requires the payment of $200,000 plus interest on September 30th, 2022. The company's fiscal year end is December 31st. The 10% rate properly reflects the time value of money for this type of note. Okay. On March 31st, Stridewell discounted the note at the Bank of East. The bank's discount rate is 12%. So, the first thing we want to do on March 31st is record any interest revenue related to this note on Stridewell's books, because this note has been accruing interest since January 1 through March 31st. So 200,000 times 10%, because that's the interest rate on the note, times 3/12 or $5,000. So Stridewell will debit interest receivable and credit interest revenue for that $5,000. Next step, determine how much Stridewell is going to receive when they sell this note to the financial institution. Well, here's how you discount a note, or determine how much you're actually going to get when you sell that note receivable. What is the face amount of the note plus the interest to maturity? So when this note matures in the end of September, the financing bank will receive $215,000 if they are still the owner of it. Well, they're not going to loan you $215,000. No, they're going to deduct interest off of that or discount it. How much? At their interest rate, which is 12%. So they take the maturity value of the note, $215,000, times 12%, times the number of months from the day they buy the note to the date it matures. So they bought it March 31st, the note matures September 30th. And they subtract that and say the difference is what cash you'll receive today, Stridewell. Oh, I wish they showed you the journal entry. So you would have debited cash for the net amount and credited notes receivable and interest receivable and the loss for the difference, just like you did when you sold the accounts receivable. June 1, debtor accepted a 6-month note paying $100,000 plus 8% interest in exchange for services rendered. Okay. They immediately went to the bank and said, we want to sell this to you, paying a 10% discount rate. So the bank charged them a 10% rate. How much cash will debtor receive? Well, first of all, find the maturity value of the note. 100,000 times 8% for 6 months times 6/12. The interest is $4,000 on that. So the maturity value is 104,000. Now multiply that by 10%. I'm sorry, yeah, 10%. And they immediately did that, so it's 6/12 is the discount, or $5,200. So 104,000 minus 5,200, 98,880. That's how you determine the value. So this was a sale, right? And this is the journal entry I was just telling you about. On the day that this occurs, we're going to credit note receivable for the full 200,000, debit cash for the total amount of cash they received, 202,100. Credit interest receivable because they're receiving that also when they sell the note. And the difference between the debits and the credits is a loss or a gain on the sale of the note receivable. So this is just a comparison of selling and how you journalize and why there's a preference from one to the other. So you could take a look at that. When is a transfer allowed to treat a transfer as a sale, a transferor, so the one selling? So the transferor has surrendered control over the asset transferred. That's number one. So sometimes it won't be explicitly stated in a contract, oh, we're using these as collateral, or we're selling these with or without recourse. So we have to look at the contract that's created between the company selling and the transferee and find out what's happening. And if these conditions are met, no matter what's in the document or the words used, you will know if you have a sale or not. The transferred assets, so accounts receivable or notes receivable, have been isolated from the transferor. So the company selling them or using them no longer owns them. They are beyond the reach of the transferor and its creditors. It's not an asset to them anymore. Each transferee, so the company buying them, has the right to use this asset they just bought as collateral for their own loans or sell them again. So they have control of that asset. They own it. And the transferor does not maintain effective control over the transferred assets. So it's truly a sale. Here's a great flow chart of those three requirements, and if they're met, it's a sale. Then we have to determine, is it without recourse or with recourse, and the characteristics associated with it. If they don't meet these three characteristics, are they pledged or assigned, and how we do the recording for those types. And we went through all of those already. We must make disclosures related to these transactions. So information that transfers must provide include the transfer, continuing involvement if they have any with the transferred assets, like if it's with recourse, any ongoing risks to the transfer, like that liability in with recourse, how fair values were estimating when recording your transaction, any cash flows occurring between the transferor and the transferee, between the buyer and the seller, and any continuing involvement in the transfer assets, how it will be accounted for on an ongoing basis. So we've got to disclose some of the details of these transactions and the contracts between the company selling the receivables and the company buying them. Here's some information on international financial accounting. On GAAP, we focus on whether control of the asset has shifted from the transferor to the transferee. IFRS requires a more complex decision process. If the company transfers substantially all the risks and rewards, if the company retains substantially all the risks and rewards. So it's a little bit more complex to determine if you have a sale or not. I'm just going to keep on going right over that. And you can see the answer there is D. I don't focus a lot on IFRS, you guys know that, but we do want to make sure you read through it. And if you have any questions, ask. There's just so many other things to look at. I had to break this presentation down into two parts, right? We will come back to these, but I just want to bring your attention. There are two very important calculations to determine efficiency of managing assets. And the first ones are introduced in this chapter, and that is receivables turnover and average collection period. Two of the most important ratios to me in measuring how well you're doing with receivables. And what we do is we take the net sales for the period, credit sales, and divide it by our average accounts receivables. So we take the beginning balance of accounts receivables plus the ending balance and divide that by 2. So that's our average. That tells us how many times a year we collect on our accounts receivable balance. If we take that result and divide it into 365 days, it now converts it into how many days we normally collect our money from the date of the sale to the date of actual collection. Now, this is an average, okay? It's not an exact, but it helps us to determine how well are we managing those accounts receivables. So there's an example for Symantec Corporation and California Inc., CA Inc. So their receivables turnover, their net sales were 4019, and their average accounts receivables were 603. 649 plus 556 divided by 2. The numbers are off a little bit with the labeling, but that's what that represents. So 603 is the 2-year average for accounts receivable. Divide that into net credit sales, 6.67 times. So this company collects on its accounts receivables on average 6.67 times, and it takes them about 55 days from the date of sale to collect the cash. Where with CA Company, they collect about 5.81 times. The norm is 8.38 for their industry. So they're both doing worse than the industry, and they take about 63 days. The norm for the industry is 44 days. So both of them have some issues as compared to other companies in their industry. And if you're like, well, maybe they're just, maybe that's just the way they are. Well, no, they're operating in the same industry. They have the same customers. So they should all be receiving their money the same way. And that's what's important to look at. You need to compare yourself to others. So Cambridge Financials lists the following: a quick computation of their 2021 average collection period. So we'll take their 2021 net sales of $8 million divided by their average accounts receivables, 200 plus 600, 800, divided by 2, 400. So 8 million divided by 400,000 will give us 20 times. Take 365 days divided by 20 times a year, They collect their money every 18.25 days. Man, I love that. So about 18 days passes from the date of the sale on average to collection. Okay, so I think we're getting kind of into the appendix a little bit, but I like teaching this so that everybody refreshes their memory. This is a very important exercise because this is one of the first things you'll do no matter what job you go into as an accountant, and that's a bank reconciliation. And this is an important tool, one of the most important, in the control of cash. We talked about cash in the beginning of the chapter. All cash receipts are deposited into a bank account. They should be. All cash disbursements are made by check or from that checking account. So a bank keeps an independent record of all the transactions in a company's cash account. The company also keeps a record of all of the transactions of its cash account. So there's two independent entities keeping track of the same thing. So you should be able to agree those two. And that's what a bank reconciliation does. Here are the steps you have to take to determine a reconciled balance of a checkbook, a bank account. When you get your bank statement at the end of the month, you should compare the bank statement's ending balance to your company's T account cash account, if you're keeping track of your checking account in that, at the end of the month. And if all the information is in both places, so everything that actually did occur in your checkbook is in your checkbook and correct, and everything that's actually occurred has been recorded at the bank, they should agree. But usually they don't. So we got to find out why and see, am I right over here at the company? Is the bank right? Or is neither of us right? So in step one is we adjust the bank balance to the corrected bank balance. So what we do is we look to see, are there any transactions in our checking account records back at the company that aren't included on the bank statement? So are not included in that bank statement ending balance. Typical types of things that will be missing are deposits in transit. So deposits we have in our checkbook back at the company that the bank has not processed on the bank statement. Well, they should have been there. It's usually a timing issue that they're not. Or there could be checks we wrote out of our checking account and have listed as decreases in our T account over at the company, but have not been cashed by the bank. So what we do is we add and subtract those missing items that aren't on the bank statement to that ending bank statement balance. Then we go to our checkbook and we go, do we have everything in the checkbook? Well, how do we know? Well, let's see. Is everything that's on the bank statement recorded in our checkbook? And if there's items missing, we need to add and subtract them and actually create journal entries to get them recorded. That's step two. So, as I said, there could be deposits that are missing from your bank statement balance in step one. There could be checks that are outstanding that have not been cashed. So what we're looking for are items in your checkbook records back at the company that are not on the bank statement yet, have not been added or subtracted. You add and subtract those missing items to the bank statement's ending balance. Sometimes there's even bank errors. So if you find an error, you adjust your bank balance and then you call the bank. The second step is, now let's see if everything on the bank statement's in our checkbook. So there could be things, maybe the bank collected money on our behalf that we didn't know about. So we never put it in our company accounting of our checkbook. Maybe the bank deducted service charges on our bank statement that we just found. Well, we didn't know about them yet, so now we do. Maybe one of our customers' checks bounced and the bank subtracted it out of our checkbook and we didn't know about it. Well, now's the time that we subtract it out. Or maybe we just made errors. Maybe we wrote a check wrong and deducted it incorrectly in our own accounting. So we make these adjustments to our checkbook balance back at the company. And once these missing items from both locations are found and added and subtracted, now the balances should agree. And there's a great picture of that. So you add deposits deposits outstanding or in transit to the ending balance of the bank statement. Ending. Subtract checks that are outstanding, add or subtract bank errors. So they're errors that are on your bank statement. On our checkbook side, our books, we start with the ending checkbook balance, or it would be our balance in our cash account, our T account. Add any deposits that we don't have recorded that are on the bank statements. Subtract any service charges or return checks from customers we weren't aware of, and correct our own mistakes. It depends on what kind of mistake we made if we're going to add or subtract it. And then these two balances should agree, and that is the true balance of your cash account. So let's look at an example. Hawthorne maintains a general checking account at First Pacific Bank. Pacific provides a bank statement and cancel checks once a month. It's the last day of the month is the cutoff day. Here's the bank statement for the month of May. So this is the bank statement. The bank said they started with a balance of $32,120. They had deposits coming from Hawthorne of $82,140. They processed $78,433 of checks. They added a service charge. Well, they subtracted a service charge, I should say. The Hawthorne had customers' checks returns that totaled $21.87, and the bank actually collected on a note or a note receivable for the bank of $11.20. So we add and subtract those items. The ending balance is $34,680. So that's what the bank statement's ending balance is. Hawthorne grabs their general ledger cash account and sees their ending balance is $35,276 for the same time period. Well, if both knew everything and had it all recorded properly, those balances should equal, but they don't. So they do a review, and here's what they find out. There were cash receipts not yet deposited in the bank of $29.65. So those are deposits not recorded or in transit. A deposit of $1,020. Wait, I'm sorry. Let me double check. A deposit of $1,020 was made on May 31st. That wasn't on the bank statement until June. All checks written in April have been processed by the bank. Okay, so any checks that were not cashed as of the end of April were cashed in May, and all the checks written in May had been cashed except for $5,536 of them. A check written for $1,790 was incorrectly recorded by the company as a disbursement for $790. So we made this mistake at our checkbook. So let's see how these items will affect our bank reconciliation. Starting here again is the information. Now, first, let's see what the correct balance of the bank statement should have been. It starts at $34,680. There were two deposits missing. They needed to be added in. The checks that have not been cashed yet need to be subtracted out. So what we're saying here is if the bank did know about these missing items, the bank statement balance would have been $33,129. Okay. There's step one. Here's step two. What's the balance in our checkbook general ledger account? $35,276. Okay, anything missing there? Yeah. There was a note collected by the bank. The assumption is we did not record that yet. Well, it should have been recorded, added in. The service charges. The assumption is they weren't recorded yet, nor were the NSF checks. Deduct them. They should have been deducted. And then that error, remember, we deducted $790, and it should have been $1790. So we didn't deduct enough. So now we've got to deduct that additional $1,000. When we add and subtract those missing items that we didn't have recorded back in our checkbook, the corrected cash balance is $33,129. Now they agree. So reconciling, finding the missing items in both areas, adding and subtracting them, your balances will agree. The next step is to make journal entries for the items that were missing from our checkbook, like that bank collection. We need to increase cash for $1,120. It was missing. We'll credit note receivable and credit interest revenue. They told us that $120 of it was interest, and you could go back and look at that slide. The bank service charge, debit that to miscellaneous expense. The NSF check, the customer's check that was not honored, it bounced. That goes back into accounts receivables. They owe us that money. And then the accounts payable must be decreased for that extra $1,000 we never subtracted when we wrote the check out. And they told us in that information what the check was for. So take a look back at that. So what do? We credit our cash account $32.67. Once we do that and post those journal entries, our cash account will have the correct balance in it. And I'm sorry, I can't go backwards in there, but go through that exercise using the T accounts. The final item in this chapter we're going to talk about is petty cash. Remember what petty cash is: just a small amount of cash that the company keeps on hand for low-cost items, postage, office supplies, delivery charges. It's too costly and inconvenient to process a check for these small payments. So companies will keep this small amount of cash in a petty cash fund, and we usually have one person in charge of it. So the company will establish a petty cash fund for a certain dollar amount. For instance, this company established a $200 petty cash fund. John Ringo is the petty cash custodian. The fund will be replenished at the end of each month. So on May 1st, the company wrote a check for $200 to John Ringo so he could go to the bank and get the cash. During the month, John paid the following bills to people out of the petty cash drawer: postage of $40, office supplies of $35, delivery charges of $55, and entertainment of $30. So he paid out a total of $160 in cash. The day the fund is established, we will debit an asset account called petty cash and credit cash, because that's where the money came from to establish that. Remember, they wrote a check. At the end of the month, when John has the petty cash replenished, that's when we debit any account for any item or disbursement. So postage expense will be debited for $40. Office supplies expense debited for $35. Delivery expense $55. And entertainment expenses $30. We do not credit petty cash. We can't replenish petty cash with petty cash. So if you decrease petty cash, it's going to have a balance of $40, and it's going to look like that's all the petty cash you have. No, you have $200, and you will always have $200. We get the cash to replenish petty cash from the cash account. So we wait until we're replenishing the petty cash to actually record in the accounts the amounts that petty cash was used for. Okay, whew. That is the end of chapter 7. So please, I know there's a lot of stuff in there. Take your time, listen to it once or twice. Please post any questions you may have.